Hi, welcome to day 14 of You Can Become a Master Series 1. Today we will discuss about callable, non-callable bonds, commercial paper and the three main risks in bonds, namely inflation risk, interest risk and currency risk. Normally, bonds have longer maturity period, let's say 20 years to maturity from the original issue date. The issue of the bond may not like to keep the bond till maturity, especially if the coupon rate appears to be high on issue and the issuer is of the opinion that one may not require the loan beyond 12 years, in which case the issuer may perhaps go for the callable option to call back the bond at the end of the 12th year instead of waiting till maturity. This is known as issuing callable bonds, where call date may be the end of 12th year, failing which it will mature at the end of 20th year, the original maturity date. Two bonds of the same issue price and coupon rate, but one is callable and another is non-callable. These two bonds will trade on different prices in the stock market depending on YTC, yield to call, and YTM, yield to maturity. Hope you have understood the difference between callable and non-callable bonds. Do you know what is commercial paper, CP? Companies are often looking for funds to have sufficient working capital for their short-term needs. That's why when they issue commercial paper, a form of promissory note, for a time period between few weeks and maximum 1 year. They are issued by large corporations, primary dealers and financial institutions. That's because only trusted companies with high credit rating can succeed in collecting funds through CPs. CPs are unsecured loans and require lot of investment. For instance, certificate of deposit, just say 1 unit, require minimum 1 lakh investment and multiples of 1 lakh thereafter. They can be listed and traded in stock exchanges. Actually, the order was issued in 2019 by Security Exchange Board of India, also known as SEBI. Are bonds really risk-free? While they ensure that the face value is returned on maturity in the currency in which it is issued, we still run three types of risks as the coupon rate is fixed. Let us examine these risks. The first risk, let's say, is inflation risk. Rising inflation will definitely cause the value of your bond to fall, and when the inflation rate rises against the coupon rate of your bond, then in real terms you lose money. In case of runaway inflation, like it happened in Zimbabwe or in Latin America, your bond becomes totally useless. Now, what about the interest rate risk? The interest rates actually keep rising and falling in any economy depending on how the economy does. Because your coupon rate is fixed, it much depends on the interest rate to know whether your investment is earning what it should. Okay. In the case of market interest rates are rising, then the bond value comes down. Supposing the interest rate in the market goes beyond your coupon rate, then it's better to invest in somewhere where your money is going to earn more, and then your bond value in the secondary market comes down heavily. But the most interesting risk is the currency risk that you encounter when you start buying bonds in other currencies than yours. Let us assume that you are an investor from US and you have invested in Naira when the Nigerian government has issued bonds maturing after 30 years. This was done in 1992 when the Naira was 10 to 1 US dollars. The coupon rate was really attractive. It was almost 4 times the coupon rate offered by the US government for bonds, and therefore you are tempted to buy this in Naira. The Nigerian currency over the years started losing its value, every year getting depreciated by substantial amounts, and today it stands at 419 Naira to a dollar. Let us assume that the Nigerian government has decided to redeem the bond and give you back your money. You have invested $100,000 in the bond which was 1 million Naira in 1992. What would be the rate that you will be getting now when they are going to give you back your 1 million Naira after 30 years? Please calculate. Almost 41 times less. That means you have invested $100,000 in bonds with the government. Of course it is secured in terms of Naira, and therefore you have got back your 1 million Naira. But when you start converting this into US dollars, it's going to be approximately 2,500 US dollars. So for investing $100,000 in 1992, you are getting back $2,500 in 2022. Friends, have you understood now what we mean by currency risk and how it can affect you if you are going to invest in any currency other than your own country's currency? So even here, the markets will actually bring the bond value down to such an extent that perhaps if you are lucky, you would have sold the bond in the secondary market for whatever price that you could get on that particular day in early 2000, and perhaps reduce the risk or minimize the risk to some extent and got back not exactly $100,000 but at least $75,000-$80,000. So when you are investing in a bond, please be aware of these risks and carefully invest so that you not only get back your money, but also your investment pays slightly higher than the market rate all through the duration. I'm going to stop here, but I'm going to also give you a game 2 on options. Tomorrow, I'm going to describe the game to you so that you can sit down, play with your partners, different types of options, right from long call, long put, short call, short put, and decide how you are going to deal in each one of these cases. We will perhaps take couple of equities instead of any of those fruits and lands, and then start working on the options. Thank you, friends. I am stopping here. See you tomorrow with game 2. Bye.